This conference will
Am I
now be
audible?
recorded.
Yes, Ghanshyam bhai. Please continue.
Sujito?
Yes, Ghanshyam bhai. Please continue.
Yeah. So I welcome you all to today's webinar, which is on GST and the critical issues arising therefrom. We have a very able speaker in Mr. Rajiv Luthia, who is going to address us on this session. Before we commence on this, I would just like to give you the backdrop of our association. It is in the 27th year that we are functioning at present. We have been holding budget meetings, study circle meetings, and webinars in the recent era of this pandemic on various subjects of academic interest. Rajiv was a past president of the immediate past president of the association, and today he is in our midst to address us on the subject. And what a coincidence, the IPL beginning immediately after the webinar. So I think this should be the trailer of the IPL which we are going to watch, and then the IPL will start at 7:30. So let's keep our fingers crossed and welcome Rajiv Bhai to address us. Wherever you are, please give him a big round of applause and welcome him. It's over to Hitesh Bhai for a short introduction of Rajiv Bhai. I think all the community members know him, who he is. Over to Hitesh Bhai for the introduction.
Ghanshyam bhai, Hitesh bhai is not there. Ghanshyam bhai, Hitesh bhai is not there. Rajiv bhai, can you hear me?
I can hear you. I think Ghanshyam bhai is not able to hear you, and he's not audible.
Yes. Actually, Hitesh bhai is not there. I will take up your brief introduction. I'm sure everybody knows Rajiv Luthia, but to give a brief introduction, he is a chartered accountant since 1987. He is a chartered accountant as well as DISA qualified, as well as he's an LLB pass out from the year 2015. He is practicing under the firm name of Rajiv Luthia and Associates since 1987. His main area of practice is service tax earlier and now GST. He has delivered various lectures at various organizations like Western India Region Council of ICAI, BCAS, CTC, AIFTP, GSTPM on various topics covering wide varieties of GST and service tax issues. He has contributed to various columns of newsletters of WRC of ICAI as well as CTC, as well as the ICAI journals. He was a co-opted member of Indirect Tax Committee of Central Council of ICAI for the year 2010, 2012, 2017. He was also a special invitee and convener for ITT Committee of GST Group of ICAI for 2016-17 year. Presently, he is a member of Indirect Tax Committee of WRC, BCS as well as CTC. With this brief introduction, we welcome CA Rajiv Luthia. Now I would request Rajiv bhai to take over the session.
At the outset, my sincere thanks to the association for having given me an opportunity to share my views or thoughts on the topic GST audit, a critical issue. As of now, today, the due date for this GST audit for March 19 is 30th of September. With all certainty, it looks like it will be extended as of now, but wait and watch for that. So very relevant topic being selected by the association. Secondly, big kudos to our association and the president and entire team for having kept us busy as well as updated with various, on various topics since the COVID year, long, almost for 6 months now, we are facing this pandemic and virtually unable to have one-to-one contact. In spite of that, I believe it's almost more than 8-10 meetings or webinars. And knowledge sharing platform is nicely being used by the association, and that has kept us updated on various topics. So that's a really wonderful job the team is doing. Well, friends, about the IPL, Ghanshyam Bhai is mentioned about, which is I'm sure more interesting as against the GST audit is concerned. And since Ghanshyam Bhai stated is almost at around 7:30, so I assure you I will not disturb your program schedule. I'll try to wind up to the extent possible within the time allotted by the association up to 6:30. Of course, it's on the lighter side. Your any issues, etc., you can put in a chat box. What I have decided today in my talk, because this is a very vast subject. Of course, this is not the first year. I'm sure all of you have already done this exercise or carried out this assignment for financial year 17-18 and 18-19. Right now we are all on the jobs. The entire discussion today, this thing is keeping back of the mind only financial year 18-19, because that is what I kept back of the mind. Secondly, there is a technical guide issued by Central Council which is revised twice, and then Western WRC has also issued a very important reference book on this GST annual return as well as audit. Annual return, Raj Kona has recently taken us through, I believe last week only. So the WRC material is concerned is quite useful, and it will be handy to you. Those who have not got it can get a very small quiz. It's like a Vijimeta Reckoner kind, but carrying very good information in that. So our discussion is concerned, I'll take you through the form also, and simultaneously the issues are also being raised there and there in front of each and every column wherever it has been affected, or other consent column. I have taken the issues. Let me tell you, there are plenty of issues on this topic of GST audit. I recollect old days when I was doing my articleship. Tax audit was introduced somewhere in 84-85, I recollect. And initial 2-3 years are concerned, people were struggling. Only good part was there was no portal kind those days. So GST portal kind of issues pausing was not there, being it was manual. But here there are some additional issues of GST portal. So settling down period is there going on right now for GST audit. With this, let us be on the talk first. The first is the auditing is concerned in the indirect taxes. The old regime, we have got so many statutes. You can see in the left hand side, and what are the mandatory audit by professionals. So if you can see in the second column, it was only under VAT and say that is central sales tax. There was audit by chartered accountant. Rest all the law, I am talking only indirect tax. There was no requirement of getting your accounts audited through chartered accountant in the old regime except VAT. Under GST, yes, that has been introduced. Section I have given reference. As against that, there were a lot of departmental audits, and that was in the old regime under service tax, excise, customs, VAT, and now under GST also is there. And special audit in the certain circumstances were concerned, that also I have listed out. If you see the major difference in GST and pre-GST, in all the three columns you will not find yes, yes, yes. It is only under GST, everything means there is an audit by a chartered accountant or professionals, cost accountant. Even department can carry out the audit based on their administrative policies, that is section 65. Apart from that, there is a special audit also under section 66 by the department. So all the three are made applicable in the GST regime, which was not. This is a major point as compared to what GST, as the government says, is a friendly law, users friendly, tax friendly, simple, but ground reality may be a different. But here more audits are there in GST as against the old law. Now here, whether when the government has in the statute, the department audit is also there, special audit is also there. Now in that case, question can arise. If we have done the audit against the account audited from a chartered accountant, does it preclude the tax authority to conduct the departmental audit? In my view, absolutely no, for the reason that all three are independent section. There is a possibility that you will have all the 3 audits for a particular financial year. Once you get it done through your chartered accountant, department can also take up the audit, and even the special audit in based on the circumstances or the leakages of revenue, your case may be selected. I am sharing one very interesting experience which we are facing for one of my client. Right now for 18-19, our GST audit is not yet completed. We are still in process, and it's very surprising that department has selected our case for departmental audit under section 65, and all the requirements they have called for, and they are on the verge of a closure of departmental audit even before our GST audit report is submitted. So this is a big shock to us, but anyway, that shows that all 3 audits are concerned parallelly can be carried out. That's important for you. Now, the relevant section through which the audit has been notified for is 35(5). I'll not reproduce the whatever is appearing on the slides that you can read, but the point here is concerned, I'll not read it everything. The more important here, unlike tax audit, here chartered accountant plus cost accountant is also a person who can carry out the audit. Practicing cost and works accountant is eligible to conduct the GST audit, and it has to be, the detailed report has to be submitted on the portal. One is audited accounts, second is a reconciliation statement, and such other forms as may be prescribed. So these are the section 35(5) provides for as regarding GST audit is concerned. The specific form for that is a certificate, and form number 9C, which has got 2 parts. One is a reconciliation and one is a certificate. These are all basic, which I will not deal more time on this. It's just for the presentation. So 9 and 9A, Raj Kona has done last week, which is annual return. Today I'll take you through GSTR 9C, which is an audit report, GST audit. Part A and Part B are the 2 parts in which it's been divided. Reconciliation is a Part A part, and Part B is a certification. Now the one rules 80 subclause 3, which is very important for this. And which the aggregate turnover is the one term. Based on the aggregate turnover limit, the audit is either applicable or not. So when we call that a threshold limit for the purpose of audit. So section 35(5) of CGST, read with rule 80 subclause 3, the present limit is 2 crore. If your turnover exceeds 2 crore, you are required to get your accounts audited under section 35(5). That is a provision, rule 80 subclause 3, and once that is there, you need to submit copy of audited account and reconciliation statement duly certified in the prescribed form through common portal. Now for the year 18-19, there is a relaxation through notification number 16 dated 23rd March, and that limit of 2 crore for the financial year 18-19 is increased to 5 crore rupees. So currently we are doing 18-19 GST audit. The limit of turnover is 5 crore as against 2 crore, which is mentioned in the rules. What will be the limit for next year is not known. The statute provides for 2 crore. Only for financial year 18-19, it is now 5 crores. The due date as of now, which is extended twice, and now it is 30th of September, which is likely to be extended based on so many representation going from various organizations, including our Institute of Chartered Accountants of India. One anomaly in the turnover, section 35(5) is concerned, which provide that the turnover exceeds the limit. As against this, the term turnover is not defined, but in the statute we have definition of aggregate turnover. This is slight anomaly between the terms being used. The rules uses the word aggregate turnover, as against the section is using the word turnover, but we will not go into the nitty-gritties of these two rather. But more important is it is important to note what is meant by turnover and how to work out. The turnover includes all the supply, whether it is a taxable supply or it is exports, whether it is exempt supply, whether it is interstate supply, and that too also qua PAN number, means PAN India. Like GST is Indian GST is a dual GST. We have followed a Brazilian Canadian model. So we have state and center, SG and CG both are there. Now our turnover is concerned, it is qua entity. If you have got 10 branches, you need to take the total of turnover of all the branches to arrive at the limit. That's why I written Pan India turnover is the one which you have to look into for the purpose. We'll take you through the examples. One small example for turnover which will be very important. For the purpose of this aggregate turnover include taxable supply, your interstate supply including branch transfers, then exempted supply plus exports if you have made, minus the taxes. So it is always net of taxes. The total of this, whatever arrived, will be a aggregate turnover. Only thing, for the purpose of aggregate turnover, even if you are paying tax on certain transaction under reverse charge mechanism, that is only for discharging the liability, but that will not form part of your turnover. So that is what been clarified for section 35. With the help of small example I have taken up here on turnover. Assume that there is a company who has got a presence in 4 states, and the turnover for financial year 18-19 for all the 4 states I have given here. Look at Gujarat, where everything is exempted turnover. So they have taken a number for Gujarat, but there is no tax liability because the turnover is 5 crore, but everything is exempted. As against that, Maharashtra, they have turnover of only 1 crore, but everything is taxable. They are paying tax. For Andhra Pradesh, they have taken a number, but that is by way of input service distributor. So where there is no supply, it's only distribution of the ITC. But turnover is nil for Andhra Pradesh. And the fourth is Rajasthan, where they have entire thing export. But this year, fortunately, there is no export, zero turnover whatsoever. Now, this is the state of the this company for financial year 18-19. The question arises whether the turnover is, whether audit is applicable. First of all, first question, I think pan India turnover, if you count, we have just seen the earlier slide, you have to see the total turnover. So in this case, total turnover goes to 6 crore, 5 plus 1. Whether it is exempted or taxable, you need to include each and every turnover, and that's why 6 crore is turnover. So first of all, that limit of 5 crore for this year you have crossed, so audit is applicable. Now, whether audit will be applicable for all the 4 branches, I think I have no doubt about Gujarat and Maharashtra, because there is a turnover, whether it is taxable or exempted, but still they will have to get their accounts for Gujarat and Maharashtra, and that is fine. Third thing is about Rajasthan, where the audit will be applicable or no. Once the turnover has crossed, there is no doubt whether your turnover is 1 rupee or 1 crore rupees, or even if you have zero turnover, still you have to get your accounts audited. So Rajasthan branch, in spite there is no turnover, also will have to get their account audited. The question remains is only about Andhra Pradesh. Andhra Pradesh is concerned, they have obtained the registration, but this registration is only as a input service distributor. Mind well, input service distributor means the turnover is always nil, but it is the only the number, the registration is obtained for the purpose of distributing the credit. So here there is no question of turnover going to come. So whether audit will be applicable or not applicable. The first is very important part here concern is global turnover, sorry, pan India turnover we have checked, but there is very interesting section 44. 44.1 and 44.2 very important. 44.1 lays down that all this section I am referring is of CGST. 44 section is about annual return. Now, how 44.1 worded is every registered person other than ISD or person paying tax under 5152 or casual taxable person or non-resident taxable person shall furnish annual return. So annual return is required to be furnished by everybody, but there are 4 exceptions. One of that is ISD. So ISD is not supposed to file the annual return. Indirectly, it is excluded or maybe exempted from filing the your annual return. Now, second question 44.2 is there. 44 subclause 2 says that every registered person who is required to get his accounts audited in accordance with this provision of section 35(5) shall furnish annual return. If you read both these section 44.1 and 44.2 together, 44.1 specifically says ISD is not required to file annual return, and 44.2 provides that if your accounts are required to get audited under GST, you should file annual return. So in that way, if you look at it, it will be a loop if you don't interpret this section harmoniously. In my view, Andhra Pradesh branch will not require to get their accounts audited, although pan India turnover is about 2 crore, but it is when you are only ISD registration, you are not going to file annual return. Once you are not going to file annual return, there will not be any reconciliation also. You will have your financial statement, but audit is nothing but I have stated in the earlier slide that your audit report is divided into 2 parts. The part A is reconciliation and part B is a certification. Reconciliation has to be done with your financial statement and the annual return. If ISD is not filing annual return, there cannot be reconciliation, and that's why there is no audit applicable in this case. So ISD audit is not required. The second is how to calculate the turnover in there are one or two examples, then we'll go about on the next part. Suppose Mr. A in his individual capacity, assume that he is not in a business also, he is only his source of income is not from business or profession. Now during this financial year 18-19, he has an income from a rent, and rent is from the shop, which we normally declare as income from property in his income tax return. Apart from that, he has sold his land worth rupees 10 crore. On that, he must have earned some capital gain on this. Fine. So total turnover for this year is 10.80 crore in his P&L account. I hope you are getting me with my speed at which I am going. This person is, in this case, he is not in a business, but he has taken registration because he has a rental income from commercial premises shop, which is exceeding the threshold limit of 20 lakhs. That's why he's already registered for GST. 80 lakhs is the rent for this year. And 10 crore is the value of the land he has sold during the year from and must have earned some profit, capital gain out of it. Whether he is required to get his accounts audited. As per the GST, what you have to look at is a pan-India turnover, aggregate turnover. And we have seen the definition of turnover. Very important point is turnover should include turnover of goods and services. In this example, this rent is a service, but the 10 crore rupees worth land is concerned is neither goods nor services. And it is falling in part 3 or schedule 3 of section 7, which contains the list of items which are neither goods nor services. Land will fall within that. It's a immovable property. So that means for the purpose of GST, the turnover is below 5 crore for this. It's only 80 lakhs turnover, although his income or the receipts for his personal P&L account or income tax purpose, it is more than 2 crore. So that is how in this case, audit will not be applicable. How to calculate the turnover is few examples. Now there are many issues related to turnover. I cannot take all considering the time constraint, but some of the item you may be in dilemma whether to include in the turnover or no. First is in you have interest or FDR, those kind of income you may be having it. You can include this interest on loan also, interest on company deposit, interest on bank FDR, etc., etc. Now there are two situations. You may be into a business and your surplus funds you have parked in the FDR for time being. Okay, it may be sometime FDs are kept out of compulsion for bank guarantees, etc., etc. So you may have that kind of income, or maybe you are given intercorporate deposits, okay, or you may be earning. So any kind of interest coming up, and you are in a business of XYZ for which you are liable to pay GST, you are already registered and complying and paying the taxes. Whether this interest, whether will be forming part of the turnover. Now the question is concerned whether interest is goods or services. For the purpose of GST, yes, activity of lending is also treated as a service. Of course, currently there is no GST on it because of the entry number 27, which gives the exemption. So it's an exempted supply of services. So it will form part of the turnover if this interest is earned during the course of a business. All the transactions which the entity is carrying out, I have given various examples of interest. That is because during the course of a business. So in my view, it will form part of the turnover. But then on the other end, suppose you are practicing chartered accountant and you are practicing in a proprietorship concern. You have two sets of books of account, one for your personal income and personal investment, etc. And second books of account is related to your profession. In that case, my view is if you have interest on FDR, which is there in your personal books of account, in my view, then that is not to be included for the purpose of turnover, because not in the course of business, it will not qualify as a service. That is my view. If it is in the same balance sheet, there is a risk. Of course, you don't want to take chance and you take commercial call and get your accounts audited because of that. That's different issue. But I'm giving you as a technically speaking, it is not in the furtherance of business, and that you can demonstrate and prove by showing a separate set of books of account, etc. Same way, dividend on shares. That is absolutely will not be a supply turnover because it has got not a lending, but you are becoming owner of the company by buying the shares to that extent. And what is coming to you is nothing but a distribution of profit. Distribution of profit cannot be a supply to that extent. So it will not be forming part of turnover. Secondly, if you are having activity or maybe you are investing in shares or trading in shares apart from your other business activity, whether that will also be form part of the turnover. In my view, it is no, because for the purpose of GST, the term goods and service both are defined, and shares are kept specifically outside the definition of either goods or service both. So for the purpose of GST, the definition excludes shares. That's why even if you go by the turnover, this is neither goods nor service, and that's why it is not to be included for the purpose of computing the threshold limit for turnover. There may be sources of your revenue by way of fluctuation for on account of foreign exchange fluctuation gain. Say you are exporter of some goods or services, and on that the GST, it is taxable item only by virtue of export. You are not paying tax because it is zero rated. Now, while recovering the money from export proceed, you get fluctuation income that is reflected as a separate item in your P&L balance sheet. It will not form part of the turnover because it is not on, it's on account of fluctuation, which is a result of the recovery of supply, not by virtue of supply. What I'm trying to say is $1 lakh worth rupees goods or service when you are exported today, say the rate today is say 75 rupees, then your turnover is 75 lakhs rupees as per this thing. And when it is realized, maybe down the line after 10-15 days or month, you receive some 76 lakhs rupees, say 1 lakh extra. That is not on account of export, but it is on account of the fluctuation, which is not part of the turnover for the purpose of computing the limit. That is my view. Lastly, there may be transaction of your creditors you may write back because of you decided not to pay or settle the transaction of lower amount. Sometimes your liability which has been provided, you write back those liability. All those items are appearing on the revenue side, P&L account, credits and income. That will not form part of the turnover, although it will be, because there is no supply happening on this. It is, although in the course of business, unless and until it is result of the supply, then only it has to be. So it will not form a part of the turnover for purpose of calculating the limit. So these are the few examples for computing the turnover for the GST purpose. Now we are going back to the form proper. 9C is the form. It is divided into two parts. I already stated part A is a reconciliation statement and part B is a certification. Part A is divided into 5 parts, 1, 2, 3, 4, 5. The one part is, I'll take you through all the parts along with the issues therein. Part 1 is a basic detail, that is name, GST number, etc. Part 2 is reconciliation of turnover. Part 3 is reconciliation of taxes. Part 4 is reconciliation of ITC. Part 5 is our auditor's recommendation, only if there is an additional liability. And then comes the part B. The part B is certification, which is again divided into two parts, part 1 and part 2. Both are certification. You will either fall into, means either you will be required to give certificate in part 1 or part 2. Who has to give in which form, that I have explained in the next slide. But this is a part B, stands for the certification. What it says that in case where the reconciliation statement is drawn by a person who has conducted the audit under any other act. I'll explain this in the next part. So in nutshell, the GST audit report has two parts. Part A is common for everybody. Part B is a certification which can change based on the facts. Let us take this thing. Now part 9C, few important caveats, very important. GSTR 9C requires auditor to reconcile annual return with audited annual accounts of the auditee. Now you have financial statements of a company and then you have annual return also, which is already filed before your GST audit is carried out and completed. So it's like old days when we were entered into this commerce arena in standard 11. I believe we have learned first thing, bank reconciliation statement. It is nothing like different than bank reconciliation statement. You have a turnover figure appearing in the financial statement audited, and you have turnover figure appearing in the annual return. And if both are same, there is no issue. But if there is a difference, that reconciliation you have to demonstrate and fill up in the various columns given in the table of the audit report 9C. So this is the first. Then part A is reconciliation is to be signed by auditor alone. Like 3CD form of tax audit report is concerned, which contain the statement of detail, as against 3CA, 3CB is the certificate by the auditors. So 3CD is concerned, contain all the information. Here part A contain all the reconciliation, but mind well, 3CD form, we always take the signature of the auditee, so that he has filled up this information and which we concur to as an auditor. mind well as against that GST, since everything has to be done on a portal, the assessee or the auditee is not going to sign. He is not supposed to sign anywhere. There is no column clause or requirement in this thing, which makes the things very risky. That entire thing is at your cost and risk. You are prepared. So reconciliation is to be signed by auditor alone. No counter signature of auditee. Auditor has to solemnly affirm that the information given is true and fair. When the audit report draft came first time for 17-18, the words were true and correct. Later on, based on various representation, including our institute representation, the government realized that true and correct will be too much to ask from the auditor, and it will cast a lot of responsibility. Otherwise, also it's there. So now they change it to true and fair. Part B prescribes the format of certificate to be issued by auditor, and he is required to confirm that the particulars given in 9C is true and fair. That's okay. Now in this concern, I told you that there are two kind of certificate. In part B, there is a part 1 and part 2. So you have to issue which certificate, which assessee which certificate. So I have explained this with the help of table. Suppose your company is concerned, which is either liable for statutory audit if it is private public limited company, or even a tax audit if it is non-corporate, something either of these two is applicable. And if it is conducted by Mr. A, and the same person is also a GST auditor. See, let me clarify here. Suppose your stat auditor is Mr. X and tax auditor is Mr. A. There also there is a possibility that stat auditor and tax auditor are different. Then it is okay. But right now in our example, we presume that our stat auditor and tax auditor are common as Mr. A only, and the same guy is concerned is conducting the GST audit, which is there in my second line of the table. If both are same, then part 1 has to be certificate has to be given in part 1 of the B part. So that format given of part 1 will be applicable to you. Now in that case, suppose stat audit is done by A and tax audit is done by X, and GST audit is again done by A, then also part 1 is applicable. Means between these two, stat audit and tax audit, a stat auditor, you have to check who is a stat auditor. Stat auditor to be checked with the compare with GST auditor. If both are same, part A. And if the stat audit is not applicable, then only you go to the tax auditor. Now there is a possibility there your tax audit or stat auditor may not be the same person who has done your GST audit. In that case, you will have to go to part 2 of the certificate. Now there is a third possibility that there is no, in the case of certain assessee, neither company audit is applicable nor tax audit is applicable, but there is a possibility only GST audit is applicable. This sounds a bit funny, but I'll tell you, suppose there is a partnership firm, there is no question of stat audit, and the turnover is below the limit prescribed by Income Tax Act for tax audit. Suppose their turnover is only 50 lakhs or maybe 80 lakhs, which is below the threshold limit fixed up by the tax audit 44AB. Then there is no tax audit also. Then how come GST audit will be applicable? In GST, mind well, the your revenue for your sale, which you revenue from sale for the financial statement is something different than the term supply in the GST, because GST is dual GST. Now, if you sell some goods from one branch to another branch, say from Mumbai to Ahmedabad, for your financial statement, your turnover is not affected, but for GST, it will be treated as supply. Then there is a sale of fixed assets. Okay, sale of fixed asset is not forming part of turnover for tax audit, but it will be a turnover for the purpose of GST. Those kind of various items are there, will become a supply under GST, but they will not be a turnover under financial statement. And there is a possibility that sometime neither tax audit nor statutory audit is applicable, but only GST audit is applicable. In that case, you need to go to part 1 only. I hope it's very clear now. What is part 1 and part 2? This is all for the use of which format for the purpose of certificate. Now ICAI has published technical guide on GST annual and audit. It has way back on 16th October 2018, and thereafter it was revised twice. And but the mind well, it is not a guidance note, it is a technical guide which is not binding on us first of all, and the views given there are also that of the authors, not of the ICAI. That's very clearly mentioned. Had it been guidance note, I think we are much protected if we follow this thing. But so it will be useful for conducting the audit, but you have to take call based on situation. The next is the WRC has also recently published a GST audit and annual return publication on this. It was there even last year also. This time the publication has come only for specifically 18-19, very important. This is just like a Vigimeta Reckner. You can get the information because technical guide of institute is more than 500 pages, very exhaustive. But if you want to refer a small book for your quick reference like Vigimeta Reckner, then WRC publication, which is less than 100 pages. Then views expressed in the guides are that of author. I already stated. Now here, very interesting thing. One thing which is mentioned in the technical guide of ICAI is that if you are internal auditor of the company, then you cannot be GST auditor. There is no such bar under the GST law. And with due respect to ICAI technical guide, but I think I don't concur to this view. If you are internal auditor, you cannot be GST auditor. Anyway, I have limited this thing on this, but under GST statute, there is no such bar whatsoever. I know one thing, internal auditor cannot be a statutory auditor, that's fine. But internal auditor cannot be GST auditor, we need to check up, but that is what is mentioned in the technical guide. Then the GST, I believe Kamlesh Bhai is already logged in, then we can ask him, he can throw light on this, but I'm not very sure about the internal audit can be a GST audit. My view, yes, it is possible. Hello, Charvik. Hello. Am I audible? Hello.
Yes, Rajiv Bhai.
I think on this, if Kamlesh Bhai is there, no, you can just, because this is institute related thing, he can be a better person. He has logged down Nilesh Bhai, Kamlesh. Someone can throw light if he is well versed about it. GST auditor may have to apply his mind judicially, keeping in mind the intent behind the law and principles and policies. That is because whether it is on test check basis or it is really only arithmetical working you have to do, or how, means what is the scope and role and responsibility. So that is also going to be an issue for that press release have come, which I'll deal with in the subsequent slide. And this technical guide is only a recommendatory and will have persuasive value, but not binding on the members of ICAI, which is mentioned in the technical guide per se also on this. Now let us take the why I have my views are based on this. I am justification in support of what all views I am getting. That is, there is a conflict as to the role of auditor, and that is the term audit, because it has been defined in GST, and that is relevant section is 2 subclause 13 of this thing, and the scope as laid down in GSTR 9C is concerned, the way the form is structured. What is role of auditor? Is it only to certify the arithmetic accuracy of the reconciliation statement? Like normally bank reconciliation statement may, whatever is the closing balance between the bank book and the bank passbook you reconcile. Whether bank book is correctly written or not written, that I don't think you will go into the detail when you do only reconciliation. And here the words have been used is reconciliation. So are we suppose our role is only arithmetic accuracy, or we are expected to verify the correctness of various aspects of GST like turnover, taxes, refund, tax credit, ITC, etc., etc. So how in the sense the tax audit was concerned, income tax 44AB, the details, the reason for introduction is to prevent the leakages of revenue, is the assessment for the department, information is readily available to the assessing officer, etc., etc. So basic, that was the object with which the tax audit was introduced. GST audit is, to my knowledge, is also on the same ground. It will prevent the leakages of revenue also, and also it will help the assessing officer to complete the assessments based on the information which is readily available, because department also doesn't do assessment for each case. There is a selected cases based on their parameters laid down. So that is the objective. So what is the intention of the government? Is the auditor required to assume responsibility? There is a big doubt. There is a representation on this also. Please clarify to that extent. Last year when it was first time audit, we have done it. Now in that case, CBEC has come out with one press release which was dated 3rd July 19 last year. Very interesting, para AH of that press release, role of chartered accountant and cost accountant. Mind well, chartered accountant and cost accountant both are entitled to carry out this or conduct this audit. So it is clarified that in certifying the reconciliation statement, what press release says, there are apprehensions that a chartered accountant or cost accountant may go beyond the books of account in their recommendation under Form 9C. I really, if you read this line 2-3 times, still you will not understand normally why I will go beyond books of account. So you will everything and anything you will try to check with the books and records. Something which is not there in books or there is no corresponding records. I mean to say, if there is a sales invoice and if it is not recorded in the books, it will form part of the records. But beyond that, I will not go by and large. That is one. The GST Act is clear in this regard. With respect to reconciliation statement, their role is limited to reconciling the value declared in annual return with the audited accounts of the taxpayer. Now, if you read this sentence, it is what is coming out is our role is only limited to reconcile the difference between the turnover and the taxes, etc., which is there in the financial statement and the annual return. So it is the taxability, interpretation issues, etc., is concerned. This press release is trying to say that our scope or role is very limited. I think it is a bit difficult to digest. On a personal side, I don't think we should go by this. You have to reasonably apply your how you conduct tax audit same way, in the same spirit you need to conduct, because the purpose of this GST audit is at par with your tax audit, because these are the only audit under the taxation law basically, and it will to prevent the leakages of revenue, etc. So of course press release can help you if there is some goof up on your part, but still it doesn't restrict your scope, is my view. If I am there, I will do it exhaustively like I am doing tax audit for years together. Now term audit is this, why I'm going by this is because the term audit has been defined for the purpose of GST, and what it says examination of records, very wide term. The term record has been defined in section 50 rule 56, and which include lot of things which we'll see in the subsequent slide. Then returns and other documents. So when I have to do audit, I am supposed to examine record, returns and other documents maintained or furnished by the assessee and rule under the which is required to be made under act or rule for that, and to verify the correctness of, the word uses correctness of turnover, taxes, refund claim, ITC, and to assess his compliance with the provision of act. Compliance with the provision of act is a very wide term, because there is a lot of compliance on a various front. It includes procedural part also. So if this is a term which is covered within the definition of audit, I don't think our scope is limited, and you can't take a shelter of that press release. But anyway, for the first year when GST audit was new, perhaps government has a liberal approach, and that's why they have come out with. But mind well, this is not by way of circular. It is by way of press release only, which has got only limited value on it as against the circular, etc. Now, fine with this, the from proper, the easiest part of this entire GST audit form is part A, which contains the basic details, and that is only period, your GST number. These are the two things you fill up. Rest all will come automatic based on your registration certificate, legal name, trade name, and if you are liable for audit, enter any other act. This is simple. Part A is over. I will not devote more time on it. Now with this, we will go to the next part of the part A, second point. Now this is entire second point is reconciliation of a turnover declared in audited financial statement, and that reconciliation you have to do with the turnover declared in annual return. That means before starting GST audit, you have to have annual return handily available with you, then only your process can start. Okay, now here the various questions are there on this column. Now first column is turnover as per audited financial statement. What you have to write? Now mind you, I told you India has a dual GST model, so you have state-wise GST. So if you have got 5 state presence, then turnover here you have to write down only turnover related to that state. So you suppose you have location in Karnataka, Gujarat, Maharashtra, etc., and you are auditor only of Maharashtra. In financial statement, it will be pan-India turnover, but you are not to write that. You have to write only Maharashtra turnover if you are a Maharashtra auditor. So turnover for this year do not include any supply transaction except turnover. Turnover means as appearing in financial statement. That's all. What is appearing in the annual return, that is the last figure. We have to arrive to that. So this is first of all, many times company do not have separate set of books of account qua state. They have one consolidated balance sheet and P&L account available. In that case, you have a tough time. You will have to get the separate branch-wise P&L balance sheet certified from the management. Otherwise, it will be very difficult for you to reconcile these transactions. Fine. Now, do not include any other income. I have explained you like dividend, etc. Although they are revenue, but that is not turnover, so don't include. I have already explained to this part of it. There may be sometime difficulty faced by you for some of the industry, like construction industry typically, where you are following a method of accounting based on percentage completion. So turnover figure is very difficult and virtually impossible to find out from the financial statement. Same way, there may be a commission agent who will just record his commission as turnover, as against in the GST, his turnover is the value of supply. Same way, the accounting system followed by the chartered accountant is his cash system of accounting, which is a turnover from income tax perspective based on accounting system. But for GST, the turnover is a billing, so there will be a big mismatch here. Air ticket agent also there will be a issue, because if the option is available under GST to discharge the liability based on certain percentage of the value of ticket, so the turnover figure there will be mismatch. So these are a few examples. Construction and our chartered accountant are biggest issue, because we follow cash system. If at all you are following accrual system, then there will not be a much problem. Secondly, unbilled revenue at the beginning of the year. Few example at the beginning of the year. So we will have April 18 to March 19 going on. What is mean by unbilled revenue? Now you have got a financial statement turnover you already put. In that you have to add this. So this word is addition, plus add is written over here in third column. Now suppose you have given premise on rental basis and earning rent, and the rent period is concerned say from 16th of the month to 15th. So in the last month, what has happened last year? 16th March 18 to 15th April 18 is a 1 month for which rent is 1 lakh. Now that means 15 days fall in this year, 15 days falls in the last year. As for his financial auditor, income accrued already 15,000. So he must have booked 50,000 rent in the last year only. But the invoice for the same is raised in current year. So for GST, entire 1 lakh has gone in this year for GST turnover. In that case, that 50,000 rupees turn out to be unbilled revenue at the beginning of the year. This can be one of the example possible for these kind of thing. Now, unadjusted advance. If you have any unadjusted advances are there, then you have to put it over here. You know that on advances received for goods, there was a tax up to November 2017, 15th of November. Thereafter, any amount received as advance for supply of goods, tax is not required to be paid. But for services, it is still there. So if you have received advances for services for which services not yet been supplied, then those kind of thing, unadjusted advance will appear over here. The next is the deemed supply, which is very important. That is Schedule 1 to Section 7. Now, mind well, the supply is concerned. I told you the sale or the revenue as per financial statement and supply as per GST is completely different. There is a Schedule 1 which lists out various items. And in that, very interesting that even transaction without consideration will never appear in financial statement, but transaction without consideration can also become a supply for the purpose of GST, and on for that valuation mechanism is also there, and you have to pay the tax also. I'll give you a few examples. There can be a stock transfer between two branches of same company. They may not charge each other anything because it is same entity. But for the purpose of GST, there will be tax effect if both the branches are located in a different state and having different numbers. There is a cross charge possible. Say you have office in Bangalore and another in Mumbai, and the Mumbai office also renders some services to Bangalore office. Okay, so for your MIS reporting, you may be raising an invoice for the accounting purpose or MIS purpose. But in any case, for GST, because both the branches are located in two different states, there is a liability of GST on this front. So that is cross charge can be one example. Third is if you give gift to the employees. Now gift is concerned, suppose you are in Sony TV is there, they are selling a TV for say 1 lakh rupees to a distributor. And for employees, they have a concession scheme that they will give to employee if they want to buy. They can buy one TV lifetime for 40,000 rupees as against 1 lakh rupees price they are charging to distributor. Now employee is a related party for the company as per GST. Okay, once it is related party, the amount charged from them should be at par with the one which is being arm's length price with the outsider. So outsider is a distributor 1 lakh. Here they are collecting only 40,000. That 60,000 will become a gift. okay, and that you may call it as a discount, but for the purpose of GST, on the tax will be required to be paid, and that is all deemed supply for the purpose of GST, which is not there in financial statement. It will appear. So this all items will appear over here, and we have to be very careful. If now we'll let us understand, if this exercise, unless and until you go and dig out the things in detail, how you will able to reconcile or do justice to the GST audit. So that's why repeatedly I'm telling you, GST audit is not just a mechanical or a reconciliation to be prepared based on the data, but you have to go look into the books and find out the transaction, and then according, otherwise you will not able to do it properly. So it is, scope is not that limited as that press release stated. Credit note issued after the end of the financial year, fine, but reflected in the annual return. So annual return is concerned, there is a time limit right now for issuing the credit notes for on account of reduction in price by way of discounts or goods returns, etc., etc. Mind well, the time limit is within 6 months from the end of the year. Now, say for March 19, the credit note issued by the company somewhere in September 19. The stat audit of that company is completed in July itself. So in July itself, the credit note were not there, so they have booked proper sales or revenue in the financial statement. When GST audit is carried out now, after 1.5 years of the year end, you know that there is a credit note given in September, and which is also valid in the sense you can reduce the tax liability to that extent. So credit note issued after the end of financial but reflected in the annual return, it is reflected in annual return. That figure you have to mention over here. To that extent, your value of supply will go down, which is not taken care of in the financial statement. Same way the trade discount is concerned. If trade discount is concerned, we have to reproduce the same trade discount accounted for in the audited financial statement, but are not permissible. Mind well, trade discount is nothing but reduction in the price. But nowadays, these trade discounts are on account of various things. Some discounts are decided before the supply. Some discounts are decided at the time of supply, and some discounts are decided or rather arrived at after the supply over a period of time. So there may be target discount, quantity discount. So all those things, you get a reduction as per section 15 in the valuation for this discount. But the condition is that the discount related document should be executed and kept ready before the transaction has happened. Otherwise, you will not get the benefit of reduction. That is a condition. So like, car dealers are there. Car dealer manufacture Maruti. Maruti has so many dealers. Maruti announces the scheme in order to increase the turnover. If they give say additional 2% discount to their dealers of the value, then there has to be a document between these two, and that is 2% for say next 3 months. Though that amount will be determined say after 3 months, but discount should be known much before the scheme is rolled out. Then only there will be reduction in the value possible. This is what about the discount is concerned. Relevant section 53. All those transactions will appear over here. Turnover for 17 April to June 17. This year it is not applicable. This has applicability only for the first year last year. So this clause is redundant now for this year. Unbilled revenue at the end of the financial year. This is absolutely reverse of the unbilled revenue at the beginning of the financial year. So I have explained that, and it is already reproduced, self-explanatory. So I'll not go into the detail of this. This PPT slide, I will be giving it to the association who can circulate. They can circulate to the participant and the members. Then unadjusted advance at the beginning of the financial year. So I have just stated that on advance also you need to pay tax if the advances are for the services. But prior to 15th November 2017, even advances received for goods were taxable. So if you have such kind of advance on which you already paid the tax and for which supply is still not happened, then those transactions will appear over here. I have given the example, nothing they think. Then credit note accounted for in the audited financial statement but are not permissible under GST. This is very important. Credit notes on account of, it may be for goods return, it may be for discount, etc. There is a time limit given 6 months from the end of the financial year. So right now we are doing audit for 18-19. The return for September was the last date in which this credit note should have been recorded. So that means 20 October you are filing the return for September as per the due date, which must appear before that. Then only it will be eligible. Thereafter, if you give the credit note, your financial credit, you can reduce that thing. For the financial accounting, your turnover goes down. But for GST, that turnover reduction you will not get, and your tax will be liable only on gross amount. So what the question here, credit note accounted for in the financial but not permissible. So you have to find out what are the credit note issued beyond the time limit, and that is you have to look at section 34 is a relevant section, and then you have to give this information. Then come adjustment on account of supply of goods by SEZ unit to DTA. This clause is applicable only to SEZ units. And mind well, question is supply of goods by SEZ to DTA. So DTA means a domestic territory, whatever entities are there in the DTA unit. Now for that only it is applicable. Whenever DTA unit is purchasing goods from SEZ, it is equivalent to the import. So they have to file bill of entry, etc. And once they file bill of entry, those transactions you have to write over here. Now in this scenario, one more thing is concerned. There is a possibility that DTA unit has placed the order to SEZ unit for supply, but in that is a condition that delivery of that has to be given to some different party which is not located in India. So I'll give example. There is a unit in Mulund which has given order to SEZ, say located in Andheri, SIDS. Now they have given the order for supply of goods, but then they have with the instruction that please supply these goods to a party in US. So what happens is that it is a bill to ship model. The bill will come to me, but the goods will go to US. In that case, the Mulund party has not to file a bill of entry. Those transactions will not be recorded here. Mind well. Only if there is a bill of entry required to be filed. So bill of entry is required only when you are clearing the goods for India, local consumption or for local use from SEZ, then only. So only those purchases you will have to record over here. Now only those supplies, not purchase, sorry. Then turnover for the period under composition scheme. Mostly composition scheme will not be applicable in audit case. So I'll not, because this is for small people and the turnover below 1.5 crore, etc. But rare case, if it is there, that turnover you have to write over here. Fine. The next is adjustment in turnover under section 15. Very, very important. See, this is a very big subject. I am taking the one which is applicable to masses and which are interesting. And that's how I am cutting short some of the points. Otherwise, we will not able to complete the important. There are around 60 slides. This plus Ghanshyam specifically want everyone to watch IPL, which is more interesting as compared to this. So, friend, the adjustment in turnover under section 15 is concerned. Now 15 is a valuation related thing. Now valuation is concerned, you have transfer pricing in income tax, you have various other things for section 48 to be, a lot of things are there in income tax, etc. Now here in GST is concerned, we have 15 section, there is a valuation mechanism. If you have sold the goods to related party, or where price is not a sole consideration, etc., etc. A lot of things are there. Fine. Now in that case, adjustment in turnover, why it is? So suppose one of the example is, suppose you have sold the goods to your related party. Now assume that you are a retail store with a 10-20 crore turnover, okay, and you are selling the goods. Most of your customers are B2C, maybe few B2B is also there. Now one of your related party, you have sold the goods. Normally a related party comes, you offer him more discounts, etc., etc. See, suppose to outsider you are selling the goods for say 100 rupees, you may charge him 90, 80, depend upon the margins and your this thing. Okay. Now, actually speaking, technically, this section 15 says that the GST is payable only on the price which you are charging to the others when you are dealing with the related party, and your price charge is lesser than that. So what happens is that although you have charged 80 rupees to related party, okay, but really speaking, you are charging 100 rupees for same goods to outsider. This 20 rupees is concerned will become a deemed supply, and that adjustment you have to do for the purpose of payment of GST, and which is, this is very, very difficult exercise. How to find out when you are into retail business, okay, in industry, etc., you may take a list of related party, what are the supply to compare. Now this is a huge exercise, okay, just merely we take a representation which not work, but this we have to be very careful and caution, because there is a leakages of revenue possible in this area. Then adjustment in turnover due to foreign exchange fluctuation. B2B, there will not be any problem, because if I charge him less, his ITC also goes down. But B2C is concerned specifically will be a difficult case, because C is not registered consumer and there is a clear loss of revenue to the government. That's why I take an example of B2C, not B2B. The next is adjustment in turnover due to foreign exchange fluctuation. If you are already showing foreign exchange fluctuation as a separate head of income, then you need not do anything over here. But if you are routing that through turnover, then only you have to suitably add or less. Otherwise, by and large, I think it's a below line item in the company audit. So that it is normally not merged with the sales. So it will in most of the audit report you'll find nil if that being the case. Then adjustment in turnover due to reason not listed. Now still, after having so many columns figures, still you are unable to reconcile the difference. There may be some item which are of a nature not falling into any of the list given here in above. Then that will fall under 5O column, and accordingly either you have to plus or minus. So you can add the reconciliation part to that extent. This is about the part A. Now thereafter you get to annual turnover. What is a turnover? And that turnover has to match with the turnover declared in annual return. If it is matching, fine. If it is not matching, that then you have to go to 5R unreconciled. I will request each one of you ensure that it matches. If it doesn't match, then you have to tell the reason why it is not matching. I am sure the moment you know the reason, where is the question of not matching, then you will definitely accommodate in any one of the column mentioned here in above. So somehow it has to be matched. Otherwise, how you will write down the reason for not matching? So we have to ensure that it match, and that ensuring is concerned not anyhow. We have to find out, which is exercise per se by itself. So unreconciled figure, ideal situation should always come 0. If it doesn't come, the next column it says reason for unreconciliation. I think that's I have not come across, because by and large in our office we ensure that it gets reconciled. With this, the turnover part is getting completed. Your reconciliation of turnover is over, and now we will go to the reconciliation of the other adjustment of the turnover. That first is annual turnover after adjustment. You will have, once you reconcile the turnover, you will have turnover into breaks up. Some of that is exempted turnover, some of that is nil rated, some of them is exports turnover, some is no supply at all like petrol, diesel, etc. So that split is there, and these columns are self-explanatory, so I will not read out here. Annual return, then value of exempted, zero rated supplies, just a column. I think these are all self-explanatory. Here very important is 7D, supplies on which tax is to be paid by recipient. So if you have such kind of turnover, like you are a transporter, then some of your turnover on which you won't be paying tax will be paid by the recipient and RCM, then that all clause will come over here. So this is merely, I don't foresee much issue in this table. By and large self-explanatory. There are more interesting slides as against these. After completing the second point, now we'll go to reconciliation of a taxes paid. The friends, I am not rushing through, but I have a lot of interesting part. That's why looking at the time, I am taking to those slides. Now, reconciliation of taxes is, once you have arrived at the turnover figure, then you have to disclose the rate-wise liability. So your item may be falling into 5%, 5% RCM. So on that, what is tax? Which is only statistical data. What is the value and how much is the tax thereon based on your turnover. So various item rates, etc. is there. I don't think much issues in this. Once you arrive at turnover, you will able to tabulate it properly, which is a taxes reconciliation. Here, the last part of this reconciliation of taxes, they have used the word interest, late fee, penalty, and others. Now, basically, apart from tax, normally person pay interest, late fee, and penalty only. What is the other? I don't have such examples as of now. But the more important with this, whether this interest and penalty and late fee. Now, is it that interest payable or interest paid? Which figure you write down? Because party has paid interest say 100 rupees, and according to it comes to 200 rupees. So are you required to write down 200 or 100? My view is concerned, you should write down whatever tax they have paid. Whatever is not paid or payable, etc., one should not write over here. Whatever amount is paid, that much you write down. Whatever penalty is concerned, you are not assessing officer. Penalty, whatever is levied and paid by the assessee, that only, or auditee, that only you have to mention over here. Late fee also same way, and based on that the figures will be appearing. After reconciling the turnover declared and reported in the audited financial statement with turnover declared in annual return along with the reason for reconciliation, the relevant part 3 of 9C require an auditor to reconcile the rate wise liability which I have mentioned, total amount payable, etc. The detail of any liability of interest under section, interest is very interesting. Under section 50, accounted for in the books of account or late fee or penalty liable under any relevant section needs to be reported here. So whatever client has written in the books of accounts or annual return, that figure only you will be mentioning. You will not calculate the interest to that extent for reporting on that table, I mean to say. Now here one example is, suppose the turnover as declared in financial statement is 6 crore rupees. While filing the annual return, they declared the turnover of 6.1 crore. Yeah, that is very much possible because as per GST, the turnover is aggregate supply, and as per financial statement, turnover is a revenue. So there is a difference. But as an auditor, when you are verified, you find according to you, turnover comes to 6.25 crore. Okay. Now what to do? How to reconcile? If you look at the reconciliation statement and the press release, what it stands for is that your job is to reconcile between 6 crore and 6 crore 10 lakh. But this reconciliation of 10 lakhs you have done, but you know that there is another 15 lakh rupees of supply which is there, but which is neither accounted in the GST return nor in the financial statement. In that case, in my view, what should be the role of auditor, what you should do? In such case, auditor should approach to auditee and disclose these facts. And if suppose auditee also agrees that yes, his turnover is 6.25 crore for the purpose of GST, and there is a short payment of GST to that extent, then if 15 lakhs rupees worth of turnover is concerned, he should add in the taxable turnover in the GST return for subsequent, and how to disclose this. For that, if they agree, then what you do is that correspondingly pay the relevant taxes through DRC 03 challan for this year and reflect this difference in table 9 of the reconciliation of taxes paid. This is when you and your auditee both agrees. But suppose if you don't, means you, in your view it is turnover, but your auditee say no, this is not turnover, I don't agree to it. Whatever you want to do, you qualify. In such case, the auditor's role is concerned, they have to give this observation in part B of GSTR 9C. So it's depend in this situation whether your assessee is agreeing to or not agreeing. Accordingly, your responsibility you have to comply to while giving the audits report. Then 10 is the reconciliation for unreconciled payment. I have told you that ensure that there is nothing remain unreconciled, otherwise you will not able to justify. In some, it has to be reconciled. The next is reconciliation statement further says that additional amount payable but not paid. Now this is by virtue of this turnover, etc. You have calculated the tax liability. There is a possibility that the tax is payable but they are not paid. The liability is not correctly discharged. Then you have to find out, and to that extent you write and divide it rate wise over here due to the reasons specified in table 6, 8 and 10 only related to that. I think this is a difference. If you get, then only this issue will come, and classify based on the percentage and declare the figure over here. To that extent, the client will have to make the payment through DRC 03 challan. And on that, interest is concerned, here the question will come, which interest? So because here the interest will be how much is payable, liable, because you have found out the additional liability. And if it is agreed by the assessee in the, or whether agreed or not, it is your view, it is payable, then interest also is a payable. So you need to calculate the interest till the date of signing report. This is the amount of the interest is concerned. We can note that it is only till the date of signing the report. Okay. Late fee and penalty, in my view, there cannot, you have no right to quantify that, because this is all discretionary. Department officers has got right to waive these penalties and late fee in certain circumstances. So in my view, the late fee and penalty will not appear, only interest which is mandatory that will appear over here. No column for areas of tax payable under RCM. Suppose some liability is there on account of RCM and that client has not paid. There is no column. In my view, it should be disclosed over here that on RCM front also there is a liability, and on that also interest is there. One should disclose that thing. It may be an oversight on the part of the draftsman to draft the form, but one has to include that. Thereafter comes the next part is concern of the reconciliation statement of ITC. Having done this much, now ITC credit is concerned. You have this table where ITC is availed in the financial statement is a column first. So how much you are availed in financial? See, availing is concerned. Availing in the books of account does not tantamount to availment of credit as per the GST statute. Unless and until you avail this credit on the portal and allocate through the GST credit ledger through to the GSTR 3B and your return, that doesn't tantamount to availment. So here A column is concerned, it is availment in the books of account. In the books of account, the credit may be there, but which is not taken on the portal will stands in the suspense account, that also to be added here. Now B column is ITC booked in the earlier year but claim in this year, then that is to be added because it has gone in books of last year and you have claim in financial year, because ITC also there is a time limit. First year the time limit was extended up to March 19. Otherwise you can claim up to September to 6 months, within up to the 6 months from the end of the year or maximum 1 year. That is a time limit for the ITC claimant. So it is possible to have a mismatch to that extent. Okay, up to September you can claim. Now ITC booked in the current financial year and to be claimed, like for March 19, there may be some ITC, but they are availed in May, June, July. So in books of account it is availed, but not in the portal. So that has to be reduced over here, which is normally we call it as ITC suspense account. And how much ITC is claimed in annual return, and then whatever is unreconciled you have to justify. I don't foresee much difficulty in this filling up this column, and reason for unreconciled you have to give it. Now here is the issue. You may come across an issue where the goods are purchased by your assessee which are in transit as on 31st of March. Say goods are coming from Bangalore to Mumbai, your assessee is of Mumbai, and the goods have been dispatched on say 30th of March. So on 30th March, e-way bill is also raised and he has to raise the invoice, so invoice is also raised. But you physically received the good on say 3rd April. Okay, now in that case, while recording the transaction in the books of account, you will record this purchase on 30th March itself and get IGST credit. That credit you are not eligible for in the month of March, because the condition required in section 16(2), one of the conditions, second condition is that you must receive the goods also to for you to eligible for credit. So you have received goods in April, so you should take credit only in April. Now these are very common issues we come across. So please check last 10-15 days purchase invoices and also check when you have received the delivery. If you have not received the delivery before March, don't take credit. If assessee has taken the credit, you have to say that this credit is not eligible, still he has taken the credit. Fine. So I hope these are the common issues which we are facing. The next is the reconciliation of ITC declared in annual return and ITC availed on expenses. Mind well, many of the columns are made optional for first 2 years, including 18-19, that I have given in my subsequent slide. But those options are not advisable to exercise. If you have a tough time passing through and for the time being you're running short of time, you're exercising the option is different thing. Otherwise it will be a tough time at the time of assessment later on. Now right now this part A 14 number clause table says that reconciliation of ITC declared in annual return and ITC availed on the expenses as per audited financial statement. This is a bit cumbersome job. Here they want an entire breakup of ITC qua each head, and this is possible for small enterprise to give but not the big ones, and this table is made optional. We are also finding it very difficult to give this unless the entity is very small, because people have ITC register but they don't have these kind of breakups. Okay, so in many cases we are also unable to give, but here if you are giving, you have to write down the value, amount of total ITC, how much is there and how much you are eligible. Like you are not eligible for many ITCs. Okay, so those ITC column you have to write down. I think most of you must be finding it difficult to this, so you can leave that stupid because it is optional to that extent. So this is about the ITC and reconcile the ITC. Thereafter, our recommendation is a 0.5. Hello, Jarvik, there is a disturbance.
Yeah,
Hello?
I'm clearing it. Yes.
Yes. The next is auditor recommendation additional liability. Now, while doing this reconciliation, you may come across that yes, the amount of tax which liability which is disclosed and discharged by the assessee is lower than as per your calculation and reconciliation. Then that difference you have to tabulate over here based on the percentage of goods and whether it is CGST, IG or you cess, etc. And on that interest or late fee, etc., whatever is there, that also you need to mention over here. I don't think much issue in that. There also the word in the table penalty is written. I told you penalty is concerned. We are not to decide the penalty. How can we decide penalty? So this is, in my view, nothing will appear over here in penalty. It will be department after the proceedings. They will either levy or may not levy. But any penalty amount, to my knowledge, is incorrect. We should not mention. Secondly, third column here is an erroneous refund to be paid back. Now, refund claims are filed by assessee, which is verified by the department based on all the detail, etc. And is it that we are again supposed to check each and every refund whether a refund is correctly given, erroneous refund? If that being the case, then where our scope will end to? Then what the hell department is doing when the refund claim is filed? And why auditor is being casted? So there are many parties who has got every month refund, and refund claim is a mammoth task to verify. Okay, so how can it be done? So that is a very dangerous. The scope is too much. In my view, erroneous refund, I don't think it is within our scope, but right now the column is there. One has to give suitable notes, which I'll discuss in the next part. Then outstanding demand to be settled, other etc. If at all it is paid, it's fine. Now the last and the part is about the verification. This is a verification clause. I solemnly affirm and declare that information given is true. And mind well, this is reconciliation. Only we are, as an auditor, has to sign, not the client. So the information given is true and fair. Earlier the word was correct. Now it is written fair to the best of my knowledge and belief, and subject to observation. The observation is very important. So which is there in my subsequent slide, and you have to sign it on this verification. This is a part B where our certificate is there and all the observation will appear. I have explained that part B, there are two certificates, certificate 1 and 2. Either of these one will be applicable. Who should go for 1 and who should go for 2, I already explained in the earlier slide. Now here the balance sheet, profit and loss account and cash flow. The important point interesting is in the certification we are saying that we have verified so and so, so and so. So are we supposed to examine? They have used the word examine. Examine balance sheet P&L account. I think why the hell we should examine, because it is already done by some auditor. No, he is certified, and as per our institute we have to rely on the work of peer. So somebody has already certified balance sheet P&L cash flow, which is true and fair. He has already given in the stat audit report, or even the tax audit report. He is certifying that. I don't think we have to examine it again. We can say it is already attached, that's all. Okay, so we are not a financial auditor to that extent. So examination word is although being used, but we need to give a diluted meaning to that extent, because two chartered accountant can come to a conclusion that this is either one will say right, wrong. It will be a this thing, but we can rely, we are supposed to rely on the work of the other auditor, unless and until it is a patently apparent mistakes appearing on the record. The cash flow statement is concerned, many a time it is not required to be maintained by the assessee. In that situation, are we supposed to give cash flow statement because of the certificate? In my view, no. You are not supposed to maintain or make the cash flow. If it's already there, then you attach. That's all. You are not supposed to prepare, and it will not affect your liability whatsoever. Auditor to report whether books of account records required under the law is maintained or no. Yes, they are very interesting, because there is a rule 56 which provides the list of books of accounts to be maintained, and if it is not maintained, you are supposed to qualify, or rather you have to give the suitable remarks or notes to that. Auditor has to report his observation, inconsistency or discrepancy, etc. Now list of record, what are to be maintained as per section 56. Every SSE will by and large are a defaulter in the records maintaining as prescribed in the list. I am talking about the moderate and the small firms. So what are the books of account? So account of goods and service imported, exported, related books. Then invoice, bill of supply, delivery challan, credit note, debit note, receipt payment, refund voucher. Receipt payment, refund voucher, many companies may not be preparing, you check. Stock register and records, very difficult for small organization. Advance received and adjustment there to register. This also I don't think it will be there separately except in books of account. And last is manufacturer to keep monthly production record showing quantity of raw material. A person having 2, 5, 10, 20 crore turnover, I'm sure many of them, it's not possible or justifiable, or it is not material also to maintain many a time. So these are a violation obviously there, because there is no exemption to anybody to that extent. Now the next is auditor need to mention the list of records which are not maintained. So if anyone is not maintained, I have put certain thing in red color. By and large, I found my assessees, These are the records we find. Many a time these are not maintained. Something in bold is not available in few of the cases. You can find out for your clients accordingly. Now, mind well, I told you that for first 2 years, that is for 17, 18 and 18, 19, within the audit report, many of the fields are being given option, which we have discussed. I'll once again tell you that please don't exercise all the options, because you're not saving time, but you are postponing the problem. Those who are having indirect tax background, they have attended VAT assessments or maybe a service tax scrutiny. You know that you need to give the computation of tax liability in a proper consolidated form, how the turnover is arrived, what is exemption, what is tax, etc., which we call as consolidated statement of a computation of a liability. Now these all the clauses require that only. Now if you are not doing it now and just filing the audit report for time constraint, I am sure this exercise you will have to do down the line, maybe 2-3 years down the line, where assessment will be on. They can do assessment up to 24, 4 years time is 6 years time is there. So it's very long period is there, so you should maintain it. Now here table 5, reconciliation of turnover, any adjustment required directly reported under 5.0. Adjustment in turnover due to reason not listed, no requirement to show the bifurcation. Here what happened is that we have seen the table 5, which has got clause A, B, C, D, E. All these breakups are very important, why you have done adjustment in turnover. Now what option says that put everything in 5.0. Now and you can straight away escape from your declaring now. That is fine, it looks very easy. But tomorrow at the time of assessment, they will tell you reconcile the turnover difference. That can be on various accounts. That time same exercise you'll have to do it. So no point in doing it. Then table 12 is also registered taxpayer has been given option not to fill the information. That is ITC which is booked in earlier financial year in the books and it is claimed in this year, that you need not disclose. What is the point? I don't foresee any reason to exercise these options, but I have pointed out those who want to follow it, they can do it. Option is available right now. Same way table 14 is there, which is the information required for the reconciliation of ITC as per the IT. Now this is the only table which we are exercising the option here. It is nothing but ITC which you are availed on various accounts like purchase, stationery, etc., etc. Split is concerned because client don't have handily available those. Okay, and we have ITC register, but item-wise breakup is not available, and which is a cumbersome job right now. So there I am exercising the option by and large. For small cases, wherever it is possible, this also we do give it. Now the scope of audit. Now in the scope of audit, certain issues are there. How whether your scope is just mere reconciliation. You take an example. There is a company ABC Limited which is operating from its office at Dadar, which is their own office. Now their associate concern. We know that in Mumbai on a same address 5566 entity or sometime more than that also exists from the same group. The offices belongs to only one person, and then there are common amenities being used, even common manpower is also being used. Okay, now here also in this example, there is an associate concern XYZ Limited which is also operating from same premises. Okay, but then there is no rental compensation being charged by ABC Limited. Now whether auditor should report, because there is no cross charge being done. Of course, if it is B2B entity, whatever cross charge is done, the ITC credit by and large, they will be available on whatever value you declare, that is in view of section 15 read with the rules. But suppose it is not charged. If it is not charged as an auditor, it will neither appear in your annual return nor appear in your financial statement, both the side. So in reconciliation also it will not be appearing. So what is the scope of auditor? Are we supposed to disclose this? In my view, yes, because the definition of audit say that he has complied to all the provisions. This is completely non-compliance to section 15 read with rule 28. Okay, so here he is supposed to charge when the supply is done. When supply is been done, although the recipient is eligible for full ITC, that's not a problem. Okay, but then your job is there is a leakage of revenue and you need to disclose this. So this is something which is very interesting. You must mention. In my view, if I am auditor, I will disclose these facts. The next is, what is the scope of audit to verify the deemed supply transactions, such as supply of goods without consideration to related party. I think we already discussed this. There is a free sample sometime being given to related parties. Now free samples to relative party is liable to GST because it is falling in the schedule 1. Very difficult to find out these kind of transactions, but then you are. So on a test check, you have to reasonable efforts you have to take for the purpose of finding out, and on sampling technique you should rely upon, and thereafter if it is missed out, it's okay. But if you get into this, you need to disclose this, although not appearing in financial statement. Then what is the auditor's responsibility in case of misstatement of financial statement? Now the auditor's responsibility is to ensure that the financial statements are presented in a manner which is accurate and accurate and accurate and accurate.
Not audible.
Rajiv bhai, we are not able to hear you.
Not audible.
Rajiv bhai is not audible.
I am calling him.
Ahmed? Yes. Can you hear? Ah, okay, okay. Okay, Charik, shall I continue?
Yes, yes.
Yeah, sorry, my apology. This I was on 2A and I was just checking. This has become a nightmare checking of 2A. But the entire problem was because of this notification number 49 of 9th of October 2019, and whereby the rule 36. Yeah, the entire issue because of this notification 49. The rule 36 was amended, and which provide that if your invoice related to input service is not appearing in 2A, then your credit will be restricted maximum to the tune of 20% of such amount which is not appearing. So now that limit of 20 is reduced to 10, etc. Fine. Now here there are a lot of technical issue we can discuss on and on for various things. That means suppose Charvik has supplied me some goods and services, and that invoice which he has uploaded rightly, wrongly, not uploaded, whatever, and it is not appearing in 2A. Now I have purchased the good service, I have complied with all the condition of section 16(2) to that extent, so I should be getting credit for the same. But because of some of the mistakes, say Charvik has already paid the taxes also to that extent, so all the conditions are fulfilled. Now why the hell my credit should be restricted? Okay, but this is what the provision as of now. Now, there could be one more possibility that suppose Charvik has today not paid the tax. He may be defaulter for the time being over a period for financial difficulty or various difficulty. Maybe after 6 months, 1 year, 2 year down the line, government could able to recover the money from him. Now, what will happen to my credit? They are not allowing my credit. If I am taking my credit, they make me pay. They are also recovering the interest and penalty from Charvik for non-payment on his outward supply. They are also recovering interest penalty for me if I am using that. So on 100 rupees of credit, they are recovering interest on 200 rupees based on utilization. I hope everybody is getting. If Charvik has not paid GST of 100 rupees and I have taken credit of 100 rupees, government is recovering interest from Charvik also and from me also. As against that, there is no loss of revenue to government. Once government recover 100 rupees from Charvik and I have taken the credit, where is the loss of revenue? So why interest? Why penalties? Why actions against both? Of course, in the process of this matching concept which was being introduced while GST was notified, because of the portal issue, still all the softwares are not in place and many of the processes are not in place, but then assessees are suffering. But on the other end, to match that meet the target of revenue, They are making the small poor businessmen as target. Few people have misused the GST provision, that's fine, but majorities are suffering on account of this. Now what is the responsibility of the auditor? In my view, for 2A, since it was not in the statute for 1819, one can take that call also. But I will put it this way today, it is better not to bang the head with the stone. At the end of the day, the power is always superior. To the extent, try to match with 2A even for 1819, and whatever, if it is small amount, etc., fine, but if it is big, let the client takes a call. But from prior to 9th October 2019, in my view, this provision cannot be made applicable. So it goes beyond our scope also to that extent. What amounts are to be disclosed in table 14, column 3-4 related to ITC availed? ITC availed during there is 20 lakhs, 4 lakh was reversed. So how to disclose in table 14? Because there is no column for reversal over there. In my view, in such case, you disclose the net amount directly 16 lakh rupees. Otherwise, there is no, because in one portal, you have limited options available. You cannot create any columns to the extent possible. The next is about the scope of the auditor further. In that case, Charvik, it is 6:35. We can take it for 3-5 minutes more, sir.
Yeah, definitely.
Yeah. In case of a difference of opinion regarding the value of supply, transaction of supply or ITC. See, when as an auditor you have some view on a transaction which your client don't agree to, and suppose annual return is filed by client or their different consultant. Now in that case, what will happen? Because auditor's job is to report. So auditor should quantify the amount also. In my view, quantification sometime wherever possible, and it can be done with all comforts, with a reasonable accuracy, then you should quantify. Otherwise, you can say that such transactions, we have a difference of opinion, which is resulting into short payment of tax or maybe excess availment of ITC. That kind of disclosure you need to mention. Quantification possible, do it, but it is extremely difficult. Then fine, you need to justify logically to that extent. So observation is must. Quantification, I told you, based on circumstances. The next is clause 2 requires registered person to maintain proper books, and these are the certain books. I told you that many of such books are not maintained. One of these example is also supply attracting RCM invoice. Whenever you are required to pay tax under reverse charge, okay, apart from the invoice issued by that service provider, you also are required to maintain or prepare your invoice. I'll give example. Suppose lawyer say you avail the services, advocate. On that transaction, you have to pay tax on reverse charge. Lawyer has given you the demand note or bill correctly. In spite of that, there is a requirement of Rule 56 that you have to make your own invoice for the same, and you have to upload on the portal, and which I am sure many assessees are not doing. To that extent, there is a violation, and which you will also come across while conducting the audit. Then you have to give a qualification or observation to that extent. Of course, these are all procedural part, not affecting the revenue or financials, but still the scope is concerned which requires us to do it. Whether person is required to verify, upload cash flow statement, I think verification is not required. Uploading, yes, but if cash flow is ready-made available and auditor is done, then only you are not to put the efforts of making the cash flow. Then for corporate, if cash flow is already prepared, no issue, otherwise not required. Then these are the few of the observations which perhaps you will find it useful when conducting audit. First is verification of payment to vendors within 180 days, which is a requisition of section 16(2) for availing ITC and thereafter reversal. What it means for those, once you avail input tax credit for any of the inward supply, the provision of section 16(2) requires that you must receive as goods and service, and payment provision to this section 16(2) say that you need to make the payment of tax along with principal amount to your supplier within 180 days. That means this is a check on your financial management or creditors payment. Now sometimes the parties are making payment on account. 180 days calculation is very difficult. Of course, nowadays the softwares are quite advanced, and you can find out also if possible, but still it's a Hercules task. You should do it on a test basis. Now what to do? Are we supposed to check each and every transaction? I feel you should do it on a test check basis, and if majority instances are not there, fine, so you can report it on test check basis. We are done, and we found, like we are reporting in 3CD while verification of TDS liability. Are you really verifying each and every transaction? I really doubt. If volumes are hefty and heavy, we do it on test check basis. Same thing you should do it over here. Then generation of invoice for inward supply for RCM. I already given example of lawyer's invoice. Many people are defaulter on this. Then GST invoice turnover. This is when company has location, multi-locational company presence in various states, but only one financial statement is there, consolidated. Then for you to identify a state-wise breakup of data is very difficult, which you rely upon the management's self-certification, because normally if auditor is not signing, then you are relying upon management this thing. Then you please mention, declare disclosure thereof that there is no separate audited accounts available state-wise, and we relied upon the management's this thing, of course. Then in case of a manufacturing concern, many a time we find that the production related records are not maintained, which I already stated. Rule 56 is there. Most of the small manufacturer, for them it is cumbersome and difficult to maintain it. Then interest under section 50, a big challenge. You know that this is a most hot debatable issues going on. We have a decision from Madras High Court saying that the liability to payment of interest on default or delayed payment of taxes is by section 50, which says that whether tax is payable on the gross amount or net amount. Net in the sense net of ITC, which you have eligible for, but it is not adjusted as of now. So the Madras High Court has already held that if you have already credit available in your ITC ledger, obviously utilization is not permitted unless you file the return, and return cannot be filed without paying taxes. So in any case, only net liability on which interest is payable, because ITC is always available with the government. Now it was expected that GST Council has also assured, and there is a press release saying that interest is applicable right from July 1st on the net amount only. But unfortunately, the notification which came recently in September, which says that this will be effective from 1st September only on net amount. Now it's very shocking that notification is law of the land, and where they didn't make it retrospective, but they made it prospective. But besides that, they have issued administrative instruction today only, and there is a 18 September. These instructions are there on the portal. You can check CBC number 20 number instruction saying that the interest will not be recovered on the gross amount. I am really surprised why it is so, why the life is made so miserable when the law, they say that it is easy. Why not that notification straight away provide that it is from 1st July only? But anyway, if now in your auditee's case, if interest is paid on net amount, you should make mention about the Madras High Court decision we relied upon. That's all. Then RCM on ocean freight, also there was a case of Gujarat High Court Mohit Mineral. Ocean freight is concerned whether tax is paid under RCM, ITC claim, whatever government, because this is also quite debatable whether tax payable or no, and we have a decision of the High Court in our favor, and it is not liable on this thing. If somebody has paid and taken the credit, somebody has not paid, there could be different situation you may come across. So put a suitable remarks to that by way of a disclosure, and refer to the Gujarat High Court decision for this. Then there is a third is high sea supply. High sea supplies are concerned non-GST supply, and it is finding place on Schedule 3 of Section 7. But mind well, this is from 1st of February 2019. And if it is for earlier period, now what to do? Whether it is a non-GST supply or other, and because it will have direct effect on your ITC eligibility. So that whatever stand you have taken, because this amendment is not retrospective, and that is causing a lot of issues. So friends, what call your assessee has taken, auditee has taken, based on that you have to give your observations or the qualification. I think within the time allotted, I tried my best to cover the max possible issues, and I hope these issues this discussion, today's webinar will be of immense use to you in very recently to complete the audit. Once again, I'll tell you that entire discussion today is restricted to for financial year 18-19 audit only. So consider keeping mind back of the mind financial year 18-19. I have presented this. Once again, sincere thanks to the organizer for having given me an opportunity. Thanks to each one of you. Over to Charvik. Thank you.
Thank you, Rajiv bhai. It was a very nice session. We have a couple of questions. Rajiv bhai, you can see in the chat options.
I'll take it this first. The figures from Excel download for 8A and auto-populated 8A portal don't match. Excel download auto-populated. Okay. Some invoice appearing in 2A but not in 8A. table despite supplier filing returns and has paid tax. So what should be taken as on reconciliation? This is more related to 2A. I already stated that 2A is concerned for 18, 19. In my view, you should not worry about. You can put a this thing that notification is prospectively applicable from October 2019, 9th, etc. So whether it is appearing in 2A or no, please, you can say that we are not, this notification being prospective, we have not compared it with 2A, that's one. And you can complete. But for your caution, I'll tell you, you are obviously going to get a notice from the department for reversal of credit, but that will become a separate aspect of litigation. For financial year 18-19, they will say your claim ITC 1 lakh, 2M it is appearing 70,000. So please pay 30,000, and for that you have to take up the matter on litigation. But audit is concerned, I don't think you should keep audit on hold for this. If a client has got documents, etc., in my view, you should take a credit by all means, and it is a good case for you to argue to that extent. Whether negative figure arising in the table 8D be recommended to pay the auditor in G, be recommended to pay.
You have put a negative figure over there. Whether you are recommending him to pay net, no.
No, absolutely no. The negative figure arising in table, that means you are recommending. In my view, it is no. And while reconciling, no, this thing you will always mention on what account is reconciliation there, and your table is also there that negative payment is the excess payment made. Otherwise, it has to be positive because you are calculating the liability leakages on account of the difference. So, in my view, absolutely no. Acha, 1 minute. Okay, fine. Then table 9. The figures of tax paid as per GSTR 9 flowing to table 9 and of 9C includes only tax figure and not interest, late fee, etc. Due to this, there is an unreconciled figure in table 9 of GSTR 9C if interest amount is reported in table 9. 1 second. I am Charvik, this I'm not, because we have figures of tax paid as per GSTR 9 flowing to table 9 of 9C include only tax figures and not interest, tax figures, etc., late fees, etc. Due to this, there is an unreconciled figure in table 9 of the 9C if interest amount is reported in table 9. I think we are able to do it, gentlemen. My contact numbers are given here, sir. Whosoever has asked this question can call me on these numbers. I will definitely, because either I have not understood his question or perhaps because we don't face this problem, honestly. So Charvik, I don't mind replying to him if he calls me on these numbers.
Yes, sir.
I have given my mobile.
Yes, sir. I also think that interest and fees figure can be written in the table 9 of 9C.
Yes, so there we are not facing this, but gentlemen, I'll definitely, whosoever is there, I'll definitely respond him on this.
Yes, sir.
Charvik, I think we are done with this.
Yes,
any other
there were 3
issues?
things.
Yes, sir.
Kamlesh Bhai Vikamsi wants to say a few words about internal and GST auditor part.
No problem, but he has written reply in private. But you can put Kamlesh Bhai, they are words of wisdom. So it will be beneficial to all of us, sir, if he is there, please.
No, Charvik Bhai has said reply in private. Can you hear me?
Yeah, obviously.
Charvik Bhai has said reply in private. It's not me who has said.
Oh, I'm sorry. Sorry, sir. Sorry.
You raised a query about, the institute saying that the internal auditor should not be GST auditor.
Correct, sir. Correct.
It's a question of independence.
Okay.
The auditor is not considered as independent because he is under the management. Okay. Whereas an auditor or a GST auditor or a tax auditor is supposed to be independent of the management. And that's the reason, means perhaps, I am not gone into it, but perhaps that is the reason why the institute is saying that the internal auditor should not be the GST auditor and certify the GST auditors. So that's the short point I wanted to make because you had raised that issue, Rajiv Bhai.
Yeah.
Thank you.
Kamlesh Bhai, can I say 1 or 2? Charvik, we have got 1 or 2 minutes, sir.
Yes, We have crossed the time, but it is fine. We can do that.
In the interest of all, only I'll take one. Since
Yeah,
Kamlesh Bhai is there, no, we can take advantage of his knowledge and information. Kamlesh Bhai, I appreciate that internal auditor is a management person treated fine. So he may have independence is at stake. That is also okay. These are all the tax audit basically under the taxation statute. So I am not certifying the true and fairness of P&L balance sheet, etc. Because somebody else has already done audit, either tax audit or the company audit. I am giving the reconciliation which is based on the data certified by somebody and some of the information related to that, which is helping government to complete the assessments. Now, in that case, can we say like the statute has no bar, and perhaps the independence is concerned, giving the true and information based on this thing, my independence should not, affect that. That is what just I am trying to put.
No, Rajiv bhai, you see, basically, the law will not say whether, the auditor should be independent or not. It's the institute who decides the code of ethics.
Okay.
So it's always like under the Companies Act as well, though there may be no bar. Now there's an express bar in the company law that an internal auditor cannot be statutory auditor or whatever. But prior to the 1956 Act, there was nothing like, internal auditor cannot be statutory auditor. However, the institute said by code of ethics that the auditor must be independence is a concept which is defined by the institute and not under any law.
Okay.
Very detailed guidelines both in India as well as internationally on the independence, which the profession itself, does. So that's the reason why the institute would have said that internal audit should not do GST audit. I mean,
okay, fine. So the matter can go to disciplinary if I do that. Yeah. Okay,
of course. He can be taken to disciplinary. He can be taken to task.
Oh, fine. No, sir. Thank you. Very important input from Kamlesh Bhai. Kamlesh Bhai, my sincere thanks for you attending this webinar and giving such an important input. Sincere thanks to you, sir.
Rajiv Bhai, pleasure. Always pleasure to hear you.
No, but the wealth of knowledge, ocean knowledge you have that, sir, and I'm sure each one of us will get it.
Of course, in a very complicated subject, which I don't understand, to be very honest.
And then I don't believe you don't understand because you are quite humble, but what you know, we all of us know, from trust to tax to audit and everything. Anyway, this is not a forum. Everybody knows you very well, sir. But my sincere thanks to you. I am obliged, sir.
No, pleasure. Thank you, Charvik. Thank you.
Charvik bhai, thank you.
Rajiv bhai. There are, I think, no further queries. So I would now request Neeta Ben Dharamshi to present a hearty vote of thanks.
Thank you, Charvik. Am I audible?
Yeah.
Yes.
Jai Jinendra and good evening to everyone. It's my pleasure to present a vote of thanks for such a wonderful webinar and such a great expert like Rajiv bhai. As per our Prime Minister Shri Narendra Modi, GST is good and simple tax. But you all know how much we have been struggling since last 3 years. And then GST audit, it's oh my God, what to do, how to do, what not to do, so many questions in our mind. But today, Rajiv bhai has given an excellent presentation on GST audit, which has cleared all our doubts and our fear of GST audit is gone. I'm sure we will complete audit with full confidence. On behalf of KDOC Association and on behalf of all the participants, I propose sincere thanks to CA Rajiv bhai for such a wonderful webinar. Rajiv bhai is one of the best experts on GST in not only in KDO community but also entire CA fraternity. Rajiv bhai, we are really proud of you. Rajiv bhai, thanks a lot for taking out time in such a busy schedule and clearing all our doubts. You really deserve a big thank you from all of us. I
owe a lot to our association who has been continuously giving me support and opportunity, and person life becomes a family, lot of support that made us to reach to some level. So a lot of support I get from all of you, and expert etc is concerned, I don't believe it to be. But anyway, I can tell you that I am involved in GST, so I know little more than what you know. Otherwise, the subject is complex. I put my efforts, and it was a humble and genuine efforts from my side to understand the subject. Learning experience is always there when you lead to a session. Thank you. Thanks for your kind word. Huh?
Raju bhai, you don't believe that you are an expert, but we all know that you are expert in GST, and earlier you were expert in service tax and other things also. So we are really thankful to you for sharing knowledge with us. I would
Thank
also
you.
like to thank President Ghansham bhai for these webinars and covering the topics which are very useful to KDO community, and thanks to all the other committee members for organizing this so well. How can I forget participants? Yes, big thank you to all of you too for joining this webinar. I would request you to let us know the topics of your interest so that we can conduct seminar on those topics. At the end, I would say, be happy today and always. Happiness has no tax limit and no GST. Thank you.
Thank you. Thank
Thank
you,
you.
sir.
So we are ending this webinar. Thanks to each and everyone.
Thank you.
Thank you, Rajiv bhai.